Good morning. How you doing?
Very good, thank you. And you?
Excellent. Excellent. I feel like this is a great time to have this conversation with some of the things that have happened in the last several days and in the last couple of months. Um, yeah. Let's get started. So, first of all, I want to say that Aurion Resources is a sponsor of my site, Goldfinger Capital. And I appreciate that sponsorship. It allows me to create a lot of the free content that I do, including this interview. David, what do you make of what has taken place in gold in the last week and the action on Friday?
Well, where to begin? It's gratifying, I guess, to finally get a reaction in gold. Although I think the typical reaction or the typical plan of attack around gold spiking on geopolitical tensions is you fade that move. It is so far a week-long move up $100, and with a very, very big day, of course, on Friday. And I think that perhaps the typical playbook won't be implemented here. I think there's a whole bunch of things going on. It isn't just these terrible atrocities that are going on in the Middle East and all of the innocent people who are going to suffer as a result of this. But there's all kinds of fog of war in terms of who will get involved, whether Iran's going to get involved, what side Saudi Arabia is going to pick, whether Hezbollah will come to the table as well. And so lots of confusion. But the overriding concern, I think, is about the U.S. balance sheet. And given that the U.S. has been pouring billions of dollars into the Ukrainian war, how can they afford to now support their allies in the Middle East? And I say allies because it isn't just Israel that will be requiring support, but probably also Egypt and I suppose perhaps not Qatar, but some of these other countries that will be expected to provide safe passage and ultimately sanctuary to the many, many, many refugees that will need housing in the coming days and weeks.
By the way, for those of you who have been under a rock for the last 10 years or don't follow the junior mining sector, I'm speaking with David Lotan, chairman of Aurion Resources, a gold exploration company focused on the central Lapland gold belt of Finland. He's also a well-regarded investor in the resource sector, and I always love to hear his thoughts on the macro, the micro, all of it. Do you think Friday's move, the $58 an ounce rally in gold, was due to, Hamas and Israel, or is there something larger at play here?
Well, it does come in the wake of Kevin McCarthy being deposed as the Speaker of the House by a group led by Matt Gaetz, who's been making a lot of noise about the U.S. dollar being displaced as a global reserve currency, and who's been making a lot of noise about the growing U.S. deficit. So I think that there's a number of things at play here, and so it isn't just Israel, Hamas, and all the trouble that's going on there. I think it's it's dawning on investors now that this is going to result in a lot more U.S. debt issuance and maybe even larger deficits next year.
Did you have a chance to read Dan Oliver's piece from last week?
I did not.
All right, so it's called On the Other Hand. It's a 5-day piece. Dan Oliver is the fund manager for Mermakin Capital, precious metal, investor, and he writes like a monthly, research note. And he had a very interesting idea. He said that gold investors are the bond bulls of 1980. Now, if we go back 43 years, 1980 was a great time to be a buyer of, treasury bonds because the yields were almost like 20% at that time, and bonds went into a 30-plus year secular bull market. Do you think that's a bit overly optimistic on his part, or is what you just said that the U.S. is going to have to finance a lot more debt issuance? There's a lot more to pay for. Is this sort of putting in place the wet dream for gold bulls?
Wet dream, whatever you mean by that, Robert. I think I think we've sort of been there since 2008. I think that the U.S. decided to take a lot of risk with their currency and with the various measures that were put in place to protect the solvency of U.S. banks and the good functioning of U.S. capital markets at the time. And there was a big step up in debt. The Fed began buying agencies, not just treasuries. I mean, just to go back to all pre-2008. Generally, the Fed supplied liquidity to the market by purchasing just the highest quality bonds out of the market, and so you got sort of a crowding out of investors from the Treasury market with the Fed balance sheet coming to the fore, and accounts that were buying treasuries would have to buy agency bonds or corporate bonds or eventually equities as you sort of pushed everybody down, down the risk spectrum by having the Treasury sort of come in and monopolize buying in the Treasury markets. What we've seen since 2008 is the Fed continually extending its balance sheet into riskier and riskier asset classes. And so now where we find ourselves is after the COVID, after the sort of pandemic measures, the Fed owns a lot of corporate bonds now. And we're one step away, I suppose, from the Fed going full Bank of Japan and actually buying equities in the equity market, just as the Swiss central bank does as well. So this has been evolutionary, but actually happening in a very short period of time. The fact that people are writing yet again about gold being on the verge of a market like the market for U.S. duration in 1981 is not a surprise, but this has been going on for quite some time now. I don't think we're right on the doorstep of this. I think we were on the doorstep in 07 and we walked in 08, and we've been inside for a long time now, and it's in progress. It's not about to start.
So I don't want to spend too much time on the macro, but I do want to ask you one more question because I'm just interested in your response to this. So, the real interest rates are very positive. I mean, the 10-year, real yield is something like 2%. If you had told any number of gold bugs 3 years ago that the 10-year real yield is going to be positive 2%, they would have said, no way. You're crazy. The economy is going to crash if that happens. It'll be way too tight. Well, what do you make of the situation, and how is gold hanging in there so well in the face of these positive yields?
Mm-hmm. Well, I guess if you're making the proposition that real rates have gone north of 2%, that depends on what your measure of inflation is. And certainly inflation is variably measured by many market commentators. There's obviously been a lot of humorous comments on Twitter recently about Paul Krugman talking about inflation being defeated since CPI x food, energy, and I can't remember what the other essential of survival is that was omitted from that measurement. But since that measurement was down year over year, that we defeated inflation. Of course, that's preposterous. And inflation happens, I think, in surges and in abrupt spikes. But since it measures the rate of change at any given moment in time, it's really hard to put your finger on what inflation is and what inflation has been. It's something that's experienced in a very personal way by people depending on their needs. So I think inflation has been higher than measured by the traditional indices. And I think that it is declining at the moment. Obviously, oil and fossil fuel prices have leveled off, and they feed into food prices. What is not abating is inflation and labor rates. I think that's a good thing for society. I think we're only on the front end of that. We went through decades of the de-organization of organized labor in the United States after all these free trade agreements came into place. Now labor is organizing in China, and you get strike after strike after strike in the United States with large increases in wages. And I think that is great. I don't think that's going anyplace. So I guess if gold appears to be down because real rates as they're measured traditionally, if gold appears to be stable in the face of real rates that appear to be positive, I would say we have some data quality issues there. Gold is performing well, in my view, versus the amount of liquidity that's being sought by countries associated with Russia for the use of gold in trade, and I'm perfectly happy with the price. But I have a real problem with inflation as the way it's being calculated, or given the way it's being calculated, and I think inflation is much higher than is measured in currently accepted manners.
Yeah, that's an interesting point. I haven't heard somebody say it quite like that. We have some data quality issues. I feel like we have some data quality issues on the employment data from the BLS. I feel like we have some data quality issues on the CPI data. I mean, there's some major data quality issues. And just, I look at my own life and my own cost of living in the last 3 years has gone up more than 30%. So, and it's not like I'm living in a bigger house or driving a nicer car. It's up over 30% in 3 years. So that tells me that the official data is not quite in alignment with the average human being. So let's turn to the junior mining sector. I didn't have a chance to be at Beaver Creek or the Denver Gold Forum in September. I had a family emergency, but I know that you did attend Beaver Creek, and I'm just interested to hear your thoughts on that conference, some takeaways from that conference, and sort of the state of the junior mining sector.
Well, it was more a funeral than a conference. There were a lot of, let me back up. It was more of an Irish wake than a conference. There was lots of revelry going on there, but there was a sort of an end of days type sense about the whole thing. A lot of people were complaining about the fact that there was no money in the sector and how abysmal the sector was, and I suppose I could see their point. We definitely have been in capital contraction for a couple of years now, and I think that it sort of snuck up on the sector. What I'd say, or at least my observations as an investor, and in addition to attending those conferences with one or two companies that I'm on the board of, I visited with some of the many companies that I have investments in. What I'd say is that the good companies really don't have a problem. If we think back about the last time the TSXV was kissing this level, and I refer to late 2015, early 2016, and people on the call, I'm sure, have heard me talk about the last time we bottomed in the market, which was, to my eye, January 20th of 2016. And we did go lower than the 470 level that we hit on that day. We did go lower during COVID, but you sort of have to take general market crashes out of those, out of your data set there, because of course they're unique events and they're often very short-lived, as was COVID. But the last time we kissed these levels, many of the stocks that are still trading today and trading well were sub 20 cents, sub 10 cents. I was looking back at where Wesdome, as an example, was trading during 2015, 2016. And I think it was, sort of, let's say 70 cents to $1.10. Now, there's a company that has had some success since then in making new discoveries, but it's an $8 stock, give or take. It's been as high as, I think, $14 or $15 over that period of time. And it's nothing like where it traded when the V was last at these levels. Aurion was a 5-cent stock at the end of 2015. It's a 50-cent stock today, and that's an awful share price, and it fills me with it's something that the company is addressing. but it's 10x higher today, and of course it's been as high as $3+ since then. And I could come up with a score of other names that were, I think Banyan Gold is a name that was probably around way back then. It was probably sub 10 cents. It's a 30-cent stock today. It's been up over $1. So things are tough. We're on the, what I would call, hard side of normal. We're probably at what I would predict would be about the lows when it comes to capital availability to the space. But the last thing that has to happen is investors who have invested in stories that will not work are going to have to take their losses and allocate that capital to names that will work. And I think that we're probably in the process of that happening now, but only at the beginning of that process.
So, I think back to the chart of market cycles, and the emotions of market cycles. And the chart never fits perfectly, it's never exact, but it's close enough in terms of the emotions that investors feel. And if we think back to the junior gold mining sector the last 3 or 4 years, we had a capitulation in March 2020, followed by a rapid rise of optimism, excitement, thrill, and then a euphoria in August, September of 2020. It's a very accelerated cycle. And we've been sort of working our way down the various, emotions, from anxiety to fear. I think we've had some panic. Where do you think we're at on that, market emotions chart? Is there still more of the negative emotions to come, or are we at the capitulation?
That's a good question. I think capitulation can happen in a variety of ways, often with a climactic sell-off like the one that we had in the last few months of 2014. And a lot of market participants either weren't around during that period or forget what it was like. But in, let's say, September of 2014, gold cracked pretty hard for the first time after having had many good years, and it was the precursor to a major collapse in the gold price. It followed the collapse in April 2013, the really big collapse in the gold price. But it looked like gold was recovering, and then in September of 2014, it had another reversal in direction. This was very, very hard on the market. Around the same time, Ned Goodman had finally lost control of Dundee Corp and Dundee Resources, which is a subsidiary of Dundee Corp, began selling off large quantities of junior stocks that Ned had been accumulating over the years. Pine Tree, which had been controlled by Sheldon Inventosh for many years and had been a major supplier of capital to the markets, defaulted on its debenture, and creditors got in control of Pine Tree and began selling off enormous quantities of junior stocks in order to meet debenture payments. And I think a couple of other funds lost their portfolio managers, and new managers inevitably take the big bath for a couple of reasons. One is they want to get rid of names so that they can participate in private placements for new names, and another reason is that they just want to take all the losses they can in order to start with the cleanest possible record. And so I think Front Street had been the sub-advisor to the CIBC Precious Metals Fund. They were let go, and Scott Valley took over that fund and dumped all of the junior names. So there was a sort of a cataclysmic event in 2014 that gained speed into the year end, and it was very, very difficult if you were a junior trader during that period of time, because there was a one-way action only. And those of us who were trapped in that market, I think, realized that the bricks and mortar, the pipes and plumbing, the infrastructure of the market was being torn apart and sold off for scrap. And we anticipated a very long rebuilding process. And 2015 was an incredibly depressing year where prices flatlined and stocks dwindled from 10 cents to 5 cents, or from 5 cents to 3 cents, and there was very little volume in the markets. 2016, I think, happened because the market got so small that only a very small amount of incremental capital was needed in order to get some of the stories going, and you had big moves for names like SolGold and NextGen, and it was the beginning of Kirkland Lake becoming a monster, and there was a lot of market value gained on very little trading and very little new capital into the business. I don't think we've ever really had much new capital come into the business. There was organic growth in capital from success in individual names like Kirkland Lake, like NextGen, going into the hands of risk-taking speculators like Warren Irwin and Eric Sprott. And occasionally we would see new entrants come into the market, like Fourth Sail, for instance. There was some generalist participation, probably starting around let's say late 2017. And those generalists piled into gold stocks in the wake of COVID. It was the best performance for gold-producing equities in years. You had a parabolic spike into the beginning of COVID, and I think I've made these remarks in a couple of podcasts recently, but this is the overhang that we're still working off for the larger cap precious metal equities. There was the presumption that oil prices would stay low for long as the world was locked down for an undetermined period of time. And there was the presumption that stimulus checks would be printed for an infinite period of time to keep people living on something while they were locked down and not at their jobs. Surprise, surprise, and I think wonderfully there was this vaccine announced in November of that year, right after Trump lost the presidency, and that began a nonstop unending throttling of the large precious metals producers. And that's the overhang that we're still working off. It scared the generous away for, well, until today. And it unfortunately put the specialists in a very bad position as their portfolio quality dropped and the liquidity in their portfolios dropped. And I'd say one of the big problems we have today is that some of the capital that is an anchor in this business, like the Franklin Precious Metals Fund or Merck, Fidelity even, those funds are either have either gone illiquid or they've lost their portfolio managers, and that's Fidelity that I'm speaking of in particular. So that all sounds terrible, except that that's what it looks like at every bottom. Do we need the capitulation sell-off that we had in 2014? I don't think so. We were tearing the business apart, firing the bankers, sending everyone home, packing up the carnival, and not moving it to the next town. There weren't going to be any more carnivals for a while. So given that we never rebuilt that infrastructure, and given that the business has just sort of been limping along from one little blip in capital availability to the next, I think we can bottom without a climactic sell-off, and that maybe we're bottoming now. And that's a lot of talking, Robert, so I'll give you a breath here. Or I'll take
I'll give you a breath.
I'll take a breath, sorry, and give
Yeah. Put your mic on mute and take some deep breaths, David. Thank you. It's interesting to hear you talk about 2014. I mean, I was around in 2014, but I wasn't really intimately involved in all those details that you just mentioned. I do remember some of the forced selling, and I feel like I've heard some rumors in the last few weeks of some, redemptions, and I don't know if I'll call it forced selling, but there's been some fund selling across the sector. I don't really have any details on that, but I can certainly, David, if you could put your phone on mute, there's a little bit of background noise. I can see it in some of the price action, out there in many different stocks. So it feels like we've got some of that. I mean, it's not maybe at the level of Q4 2014. But my next comment is going to be, well, it's October 16th, and we know what takes place over the next couple of months every single year in this sector. We get the tax loss selling silly season, and nobody really knows how pronounced it will be this year because it's obviously been a down year already. There's been a lot of selling in the last several months. What are your thoughts on this year's tax loss selling season, and might we be on the cusp of that larger sell-off that could put in a capitulation bottom?
Well, I think that we're getting close to the level that I would traditionally associate with being the bottom of the market. I guess we could go below 470, which was the end of the last bear market. But I tend to look at those levels as being an expression of what minimum capital looks like for this business. And when I look around and think about how healthy the cash flow is at a lot of the senior producers and where their balance sheets are today, I don't think we need to fall too much further. I think what we really need to see is a move by the larger producers to begin to replace their reserves. I think that that's what's coming next. I'm not sure exactly what that looks like. Obviously, Barrick's continual flirtation with copper creates some noise around that, but you couldn't argue gold's utility. Couldn't argue for more utility for gold, for instance, than today, given where the U.S. balance sheet is headed. So, Yes, I guess tax loss selling season could make things worse, and I suppose we could breach 470, but I don't really think you would. I mean, I think that this is really the season to be buying, and I think that a lot of veterans will see that.
Okay, fair enough. I think that's a well put. Are there any tips you might give to another investor, maybe a novice investor or somebody not quite as experienced as you are, as to what you will be, looking at over the next couple months? Like, what opportunities are you looking to take advantage of if this is the time to be buying?
Well, I think that my own strategies around these kinds of markets remains as it has been over the years, and we've been through a bunch of downturns since 2015. It was a very, very long and ugly period for markets from, let's say, the middle of 2017 till June of 2019. And I think during those periods, you tend to notice that the price, the market cap of quality names converges with low quality names, and your job at that point in time is to bite your lip, take your losses on the lower quality names, and buy the things that you think are higher quality. And you might still look at those stocks and have some doubt that they will survive. But if you're running a portfolio that is seeking the kinds of opportunities that you seek in junior markets, and those are companies that can multiply in value 5, 10, 20, 50-fold, unfortunately, these are the markets that you find them in. And it's unfortunate for most, because generally, if you're in these markets, you're already nursing some pretty significant losses. Just when things feel as painful as they can feel, and when you look at your portfolio and it's a humiliating experience, that is most often the time to buy, the time to get long the space. If you want to talk about the specifics, it's just companies that you have conviction will survive. Either they have some cash on the balance sheet to make it through a year or two, or you look at the people involved in the company and you understand that they will always have access to capital. Specifically, and I'm just going to choose one example. This is something that I own and something that I'm not recommending necessarily, but Highlander Silver just announced a restructuring and a refinancing with Richard Wark putting some money in alongside, with the Lundin family coming in alongside of him. I don't think anyone really understood what was going on in that company. It was a Peruvian silver play that Dan Earl put together in his spare time after he went into Solaris to work with Richard. Richard put some money in. I think people were sort of excited about what could happen there. Solaris was cooking at the time, and really, in the end, it just didn't work. And the founding vendor, Phil Anderson, is gone from the company, and I don't know if Dan's going to stay around, but that's a perfect example of something that's just always going to have access to capital. And now it's, I suppose, become Richard's vehicle, and to some extent Richard's vehicle and the Lundin's vehicle. So you look at that balance sheet, you look at that share structure, and you might think, what's the point? But it's a classic bear market bet on jockeys. And again, I own the stock. I don't own very much of the stock. I just pick it as a good example of how you would look at a company with not much balance sheet, because I think they're only putting $3 million in. And I don't think that that'll do anything but keep the lights on while they look for a new deal in that company. But those are the kinds of things I look at, and I think, well, not a lot of balance sheet there, not a lot of run room, but probably going to be a new story in a year's time, and with some very, very successful Hall of Fame resource market participants at the helm. So,
yeah, you bet the jockeys there. And speaking of betting the jockeys, so you're the jockey of Aurion Resources, the largest shareholder, I believe, once again, and buying the stock regularly on the open market. So let's talk a little bit about Aurion. So some of the news you put out the last couple of months, you've repurchased royalties on some of your major properties there in Finland, made a new discovery with the JV at Helmi, near Helmi. And you signed an option agreement with Kinross on Launi East. So several pieces of news. Pick one or all of them, and let us hear more about what's going on at Aurion.
Well, I wouldn't say that I'm the jockey on that play. Just one of the owners, or one of an ownership syndicate in the stands with binoculars, watching what I hope is the horse race coming into the final stretch. Although I felt that way for a number of years now, and it hasn't. It hasn't quite. We haven't quite gotten to that final stretch yet. They keep stretching it at the racetrack. The company is doing everything that it should do, including and most importantly, buying things when things are cheap. And secondly, carving its operations down to a fine point so that the company has ample capital to do the thing that adds the most value, which is drill, but doing not much else. We used to run that company to make multiple discoveries, and that is still the way the company is run. The difference is the advanced work that we would have to do on various areas to make those discoveries has been reduced to just base till sampling. We used to run large trenching programs on other properties. Now everything is focused on Aristi, our contributions to the JV, and on developing more and more targets around the sort of Amorusko, Risti, Karasoka corridor. It's not expensive. The company has probably 1/5 of the employees that it used to have active in the field. But I'm confident that over the years we've done enough work on targets and have enough target inventory that will be enough to make one of the next discoveries in the region. And I say one of the next discoveries because I'm sure that Rupert is in a similar vein working on making new discoveries, just as we know B2 is. Not much more to say there, really. I'm keenly awaiting results from drilling on our 100% owned ground, just as the market is. I'm completely in the dark on that program. I guess the only other thing I'd add is that we bought a royalty back on the joint venture grounds from Dragon Mining, which had been hanging around for quite some time and which was probably an impediment to, I don't want to call it consolidation, that's a word I use from time to time, but it was probably an impediment to all of the companies in and around the Ikkari discovery coming up with a plan that will make that what it should be, which is the next project to go into development by a major gold producer. So I don't think that it's necessarily that it was as catalytic as we might have thought it would be, but I think that it's a very, very important development for that space. And so we'll see how that factors into things that happen in the next 12 months.
You put out some drill results that definitely caught my attention and caught some other people's attention. But I think the market is waiting for the follow-up to those, results. Risti, and even this JV discovery of Vuoma, south of Helmi.
Yes.
And I feel like the market just loses patience, in this environment. Everybody wants assays very quickly. And the reality is that that's not the way the junior mining sector works, usually.
Mm-hmm.
Are you most excited about the, Risty discovery, or are you equally excited by the various properties?
I am very excited to be part of a developing camp. I think the complex part of the equation is that there are three companies clustered around the best discovery in the camp. Of course, it's owned by Rupert, and it's a toss-up in my mind whether the second best discovery in the camp is the Helmy discovery, which B2 has made across the border, or whether it's this Karaselka discovery that has been happening in slow motion on Risty, that we own 100% of. And I say slow motion because Karaselka was drilled as a zinc prospect in the 1980s by the Geological Survey, 127 holes to 50 meters depth, 70 meters length on average. It was tendered out to the junior markets and disappeared into a little company called Tertiary for years, and then Mike bought it for not very much money a few years ago. He wasn't able to do any work on it or couldn't make it a priority because the company was fully engaged in first Amorusko and then Amorusko and Lowney. And finally, when Mike had his personal tragedy and left the company, and Matty Talika came into the property, it became his number one priority. So this has been years and years in the making, and the company uses less capital on its 100% owned ground than it used to, so Karaselka is moving at a slow pace. And one of the reasons that it's slow is because we are not going to saturation bomb it. The company is going to drill it, agonizingly review oriented core and geochem, and be very, very careful about figuring out how to follow it and how to locate the higher grade shoots in it. So it's frustrating for everyone, and most frustrating for me. Well, sorry, I shouldn't say most frustrating for me. It's as frustrating for me as it is for any shareholder. I just happen to be a fairly large one. I guess the good news is I've gotten to buy some more stock and managed to get close to catching Kinross again as the largest shareholder. And while I'm always happy when I get to go and refill in the secondary markets against the dilution I've taken in the financings that we do, our job is to deliver price and volume to our shareholders, not to have the chairman come in and scoop up stock at a bargain. So I'll be happy, and perhaps not as happy as everyone else when that period finally comes to a close, and it will.
Yeah, it's interesting to hear you talk about buying shares and increasing your holdings. Some people might look upon that as a burden. The way you speak about it is almost like it's a gift.
Well, it's certainly, to me, a gift when I get to reverse the dilution that I've taken in financings at a lower price than those who participated in the financing. But we owe them so much more than that, both the participants in the financings and our passive shareholders. So I'm happy to be owning shares at these prices, as evidenced by my purchases, I guess. But at the same time, what we really crave is to be at the top of that venture list again, trading big volumes and delivering new discoveries and a higher share price to our passive shareholders. And so, yes, I suppose it's a gift, but at the same time, we need to start giving that gift to or we need to start making reciprocal gifts to to our other shareholders.
To your current shareholders, yeah. Yeah, and I'm just looking at the volume today, 101 shares. But, Aurion trades about 45,000 shares on average. Like, I can recall at some point in 2021, I think that was almost 100,000 shares in average daily volume. I guess I will open up the floor if anybody has a question for David Lotan. I do want to ask you this, David. How much cash does the company have in the treasury right now? How much runway does that give you? And I think I did a spreadsheet maybe 6 or so months ago. I calculated your cost basis. It was like 50 cents a share. Is that still accurate?
I don't keep track. I think it's 60-ish, give or take. Yeah. Yeah, but I can't be sure.
Okay, about 60 cents a share. Okay.
It's irrelevant to me, as I am there until the bitter end.
Well,
let me rephrase
it's
that.
Not a bitter end. It's not a bitter end.
I'm there until the exultant's conclusion.
The glorious end. And if anybody has a question for David, please ask to speak, and I'll open your mic. And the company's current cash is.
I think we've guided that we'll finish the year with $5 or $6 million in the bank, and I think we had $13 million in working capital at the end of June. So I think we're still on track for that, and that gives us the option to sit around or do nothing for 18 months or so, if need be. I don't think that'll end up being the case, and of course we have. Despite the fact that our share price is not where I want it to be, despite the fact that markets are not offering a lot of capital these days, given Kinross and Newmont and some of the other groups on the balance sheet, I think that capital is available to us if and when we want it, but hopefully at higher prices.
I'll ask one more question about buying back the royalties. Why was that important that you bought those back? And was that opportunistic? You feel like you had a window of opportunity to close that, and maybe in a better market you wouldn't have had that opportunity?
Yes. The 3% NSR in favor of Dragon could be bought down to 2% with a €4 million payment. And there were milestone payments due solely by Aurion for every million ounces of resource that were produced. So if B2 had chosen to do a resource this year and produced 1 million ounces, Aurion would have owed €2 million to Dragon Mining, and then €1 million for every million ounces after that. I think our contribution to that royalty buyback was €500,000 and another €1 million worth of Aurion stock, and B2 put up their 70% in cash, which was €3.5 million. So for Aurion to get rid of the royalty, which would have been a 30-70 burden on all involved, and those resource milestone payments for €500,000 of cash and some stock, was a fantastic transaction.
Okay, I'm gonna activate a Lavrion Mining. We'll take one question. Go ahead, Lavrion. I activated your speaker mic, but it says you're connecting. Oh well. He jumped up to ask a question. I activated him, and then he logged off. Okay. Oh, he's back now. Well, I'll give him 30 seconds if he wants to say something. But yeah, thanks a lot for this conversation, David. I think it was very worthwhile for many reasons, including the history lesson about 2014, 2015. I think a lot of people who are investors in the sector today were not really around back then. Paul, okay, so we're going to take a question here from Paul. I have activated your speaker mic.
Hi there. I was wondering about the safest area in the next 5 years as far as the junior miners are concerned. I can't see that areas in Africa being too appealing, but wanted to hear your take on that.
Yeah, that's a great question, Paul. I think it's always a matter of price. I've never been crazy about Africa. Well, sorry, let me rephrase that. I invested quite a lot in West Africa at one point in time, but it ended up being sort of a graveyard of capital as one name after the next ceased to perform, and as you had one coup after the next in all of these African countries. And even though we're having a lot of coups recently, we had quite a number of them 5 years ago as well. And so we're sort of in the second generation of coups there. All the while, though, Maya, gold and silver, was sitting in Morocco as a piddling little 30-cent stock. I think maybe they rolled back 3 for 1, so let's say it was 90-cent equivalent. And a few of us who were interested in Morocco, I think, thought that was very interesting geology and thought it was interesting the way that company was bootstrapping its way into production. And now it's I think maybe it was at its peak an $11 or $12 stock, and maybe it's a $7 or $8 stock today. Really an incredible performance. And so it was cheap enough, and it was prospective enough, and it's been a fantastic return. And I think the same could be said of New Pacific in Bolivia, and maybe what will be San Cristobal or whatever they're going to call that company when they take it public. Ecuador was, of course, a graveyard for capital for years as well, and then Fortress turned into Lundin Gold and went from a dollar stock to, let's say, a $15 stock today. So even in the worst places, if you get good management and a good asset, you can make a lot of money. And so there's really no jurisdiction that is a complete no-go for me, but it is a matter of price.
All right, great answer. I'm going to take one more question. I got to wrap up in 3 minutes here. So Stella, I'm going to activate your speaker mic, and you have the floor to ask a question to David.
I think Stella's on mute still.
Yeah, you got to open your mic, unmute yourself.
You hear me now?
Yes.
Thank you very much. So I read The Price by Daniel Yergin. I believe you were the one who recommended it a little while ago. I was wondering if you had any other book recommendations.
That comes out of nowhere. The Prize is a fantastic book indeed, and I think if you're interested in the history of natural resources, it's one of the best reads ever. I've often said that between The Prize and Ron Chernow's biography of the Morgan family, you'd understand everything you needed to know about capital markets, where they are today. Probably one of the most interesting books I've read recently was by Nathan Vardy. It's called For Blood and Money, and it's about the development of a novel drug for blood cancer or various blood cancers. And the only reason I would recommend that to a crowd of natural resource investors is if you want to see a sector that truly burns capital in the name of research and development, you need to look at the biotech sector in the United States. and the billions of dollars of capital that go into the development of, or the pursuit of new drugs for diseases that are mankind's greatest concern, and how often they fail. It's a great book. It's a great read. Bob Duggan comes in and takes over this small company. I think he'd made his money as a venture capitalist in the cookie business, believe it or not. It manages to raise $1 billion for this little company that comes up with a blockbuster cancer drug, and I believe he walks out with a $3.5 billion payoff or something like that. It isn't just a book about the amount of capital that goes into drug development and the sort of wins that are available there, though. It's a wonderful book that starts every chapter with the story of someone who got onto this drug trial, who had no options left and very little chance of surviving, who had an incredible success story. So it's a great read. It isn't natural resources, but there's a real similarity in the process of finding mineral deposits and the process of finding new drugs.
Yeah, it's not an accident that biotech is like my second sector, David. It's very similar risk reward and excruciating timelines to FDA approval.
The capital required is a multiple, and
enormous
success, and the odds of success are a fraction.
Yeah, absolutely enormous. Thank you so much for this hour. I really appreciate it. I think everybody will, and I will post the recording, and it will be up on my YouTube channel tomorrow. So thanks a lot. Have a great rest of your day, everybody.
Thanks so much, Robert.
I hope that you received some value from this video. Please stay tuned to goldfinger.capital for updates and new videos. Have a powerful day.